Welcome everyone. This is the video, the small concepts that we need to master for study unit D, relating specifically to foreign transactions and foreign entities. So from a group perspective, you will see that the study unit is thrown in there, IAS 21. But remember, I can ask IAS 21 in your separate financial statements, the foreign currency part. But then for a group perspective, we need to know how to treat a foreign entity. And that's what we will focus on. But I'm going to also explain the foreign transaction part for you. So I'm going to share my screen. Make sure you are comfortable with what needs to happen. So we need to see how we need to translate foreign currency transactions and amounts specifically to present it in my financial statement. And we also need to see how we will consolidate foreign operations. So there's two parts to this chapter. The main thing is you need to be able to distinguish between the functional currency and the presentation currency. I'm not going to go into the detail of that, something that you should have done pre-grad. If you struggle with that, go and look at IAS 21 to see what they mean about the functional currency and the presentation currency. So the moment my presentation currency is different, there's ways I need to translate, and that's what we're going to focus on. If we have our functional currency and our presentation currency, we need to be able to translate items in my financial statement so that it's disclosed at the correct currency. And when I have a foreign operation, we need to also now use that same principles, also calculate goodwill and get movements of goodwill due to the foreign currencies and recognize the exchange differences in each year relating to that goodwill specifically. If we think about our concepts that you need to master, you need to know what's the presentation currency, and the functional currency, you need to know what to do. Whenever we translate items to our presentation currency, we need to see monetary items. We need to know what's monetary items. It's units or currency held as assets and liabilities to receive or be paid. I need to know what's a monetary item. I need to know what's a spot rate and a closing rate. Because the following works, or the following is determined by IAS 21. How do I, at the end of the day, translate items? For monetary asset, I will use the closing rate at each end of the year to measure them. Non-monetary assets is measured in terms of the historical cost. We don't restate that, but we will use the historical rate to translate them. So we will not keep on using a new rate at the end of the day. So non-monetary items, non-monetary assets at a historical rate at a historical cost. And then when non-monetary items is measured at fair value at the end of the day, we will use to translate the exchange rate the date when the fair value was measured. So I need to see that measurement principle. So important to know the difference between monetary and non-monetary items. The difference that I then get will be exchange loss or exchange, but I need to know where I need to recognize it. But any fair value changes from non-monetary assets that is measured at fair value will be recognized in OCI, and the rest will all be recognized within statement of profit and loss. Okay. So you can work through this couple of currencies, make sure that you understand it and understand how to account for it. Then we have translation rules. When we have assets and liabilities, we will use the closing rate at the end of the financial position. Income expenses, we will use an average rate if we don't have a specific date with a specific transaction. If it's something that accumulated during the course of the year, we can use an average rate. And exchange differences is recognized within other comprehensive income in my component in equity as a translation reserve. So make sure that you understand this translation of the foreign currencies. So then when we look at foreign operations, completely something different that we need to understand. And this is now from a group perspective. So I need to know what's a foreign operation. Okay. For that, I need to see either subsidiary, associate, or a joint arrangement, which is in a foreign currency, and I need to then translate it back to my reporting currency in my reporting entity. If we look at that, there's certain rules again that I need to apply. So all my assets and liabilities will be at my closing rate. Capital and any pre-acquisition reserves at the historical rate at the date I obtain control, okay, or the date of acquisition. acquisition reserve. So profit for each year will be at the average rate for that specific year. Dividends will be at the rate of that date specifically. And then I will calculate the balance, the closing rate again. What if I have all my assets and liabilities, my consolidated financial statements, and the balancing figure will then be exchange difference that I need to recognize. The way they show it for us to make it simple, they have a specific structure in mind. We'll take all my assets, multiply by my closing rate, capital share premium historical rate. I have all my other profits, dividends, specific rates. I will get my liabilities closing rate, and then to get to this balance, multiply by my closing rate, I will see that there's a difference, and I will need to, at the end of the day, get the movement, and that's the exchange difference. In the statement of profit and loss, I will use my average rates to get it and translate it if they ask me the statement of profit and loss. So make sure you understand the difference between the foreign entity, the foreign operation, and the normal transaction. So when we calculate goodwill, for instance, again, they have a spread structure. So we will start with our consideration transfer, NCI, our share capital, it's that at acquisition part that we normally have for a group, and we will get our total values, and then we translate. So we use our functional currency, translate at the closing rate or the rate at the date of control at acquisition, and we have our items. And then if there's any movements, we recognize it. So if there's impairment to goodwill, we will use the average rate here. But then we will get our balance, we will have a closing rate. And every time we will now see that there's a movement, we will recognize that exchange difference. And please make sure that this exchange difference will, at the end of the day, go to OCI. So I just want to show you something. For instance, the way it's calculated, we will have our property, plant, and equipment, and all our entity assets calculated at the closing rate. Then here we will use our historic rate, the specific rate for each year. Then we will have our current assets, our closing rate, and now I need to see that needs to balance that 1610 is my net assets and net liabilities. Looking at that closing balance for the assets, and then the balancing figure after I translated everything, that will be my exchange difference, which I need to recognize. And then if we look at goodwill, we will have our consideration transfer, use our rates at the date of acquisition, and then compare that now to my new item at the new closing rate. So each year it moves. So even if there's no impairment, because there's a change in currency for the year, I will now recognize an exchange gain or loss for that specific year. Please make sure you understand how to translate the foreign currencies, the foreign operations, and make sure you understand how to treat those items. Then if we look at monetary items from a net investment in a foreign operation, we need to understand what's a net investment, because there's a different way to treat that. You need to make sure you understand what's a net investment and how to present that in my separate and my consolidated financial statements. So work through the principles, make sure you understand what is expected of you, and I really hope this helps you to just wrap your head around IAS 21, foreign currencies and foreign operations. Have an awesome day, keep well and clean.